So the question I would like to answer today is, why do I have to pay interest on my money? Coming from a financial background, this is what I do. I'm in finance, and I can answer that question in kind of many different ways. But basically, if you think about interest, it is the price of money. If money were sitting on a shelf and you looked at the price, that would be your interest rate. A lot of people say, well, how is it calculated? There's formulas out there that give you the calculation of interest and has to do with the time value of money. But the greatest example I can possibly give is you lend your buddy $100 for the month. He needs to do whatever. 15 days into the month, there's a really good sale on something you wanted to buy. A new part for a car, radio, stereo, ring, whatever. And it's on sale for $80. Normally it's $100. So that's a $20 savings. Now, you don't have that $20, or you don't have that $80 or $100 because you lent your friend the $100. So theoretically, the cost of that money is $20. So at the end of the month, if your friend gave you $120, that would be the value of that money. It's kind of a poor example, but it's kind of the best way I can explain it. A lot of times you hear banks, and the big one is the Federal Reserve, obviously, adjusting interest rates. And the way that banks look at money is the longer it's out there, the more risk it is for it not to be paid back. That's why typically not your long-term 30-year fixed-rate mortgages, they tend to be lower interest rates because they're bought on the secondary market and combined into a pool, which I can go into that in a different video. But your car loans, for instance, are short terms, usually 5 years, 7 years. Lower interest rates on newer cars because there's less risk that that car is going to break down, you're going to walk away from the loan. And that's really kind of what interest is. It's a lot of times it's the time value of money, and it's also the risk involved. So a good example is why a lower credit score is a higher interest rate. And the reason is because when banks look at your credit scores, if it's a lower rate or lower credit score and there's a lot of issues on there, delinquencies, things like that, you are more risky. That's why you get a higher interest rate. I know some of these topics are going to be, somebody's going to watch this video and go, oh yeah, dumb, that's common sense. But a lot of people don't know this. I know I was young and dumb and did a lot of dumb things in my past, and I wish I would have listened to advice I was given way back then. I probably would have been in a better position now. But that's why I want to do these videos. So maybe somebody out there is a senior, junior in high school going, I should probably keep my credit score good because it's going to affect how much I pay in the future. So that's pretty much on interest rates. And if you have any questions or comments, please leave them below, and I'll try and get to them. Look forward to the next video. Thank you.